Fund management can be a tough business. Sometimes skill in managing others' money isn't quite enough. Distribution, a client base, and the ability to attract capital from the word go is as important for survival of an asset manager. Now throw in BEE and it can make it that much more interesting. Tonight we have Masimo Magerman, the MD of Mergence Investment Managers, joining us to discuss some findings of this 2074 BEE survey. Massimo, thank you so much for joining us today. I'll start off with you and just get some background to Mergence Investment Managers. Can you tell us a little bit more about how you fit into the BE asset management space?
Yeah, Mergence is a boutique asset manager based in Cape Town. We started the company in 2004. It's 100% black owned, and it's got a high PDI of management in the group, roughly about 70%. We've got like 6 managers, portfolio managers, and 5 of those are PDI candidates. The company's grown from roughly 500 million in 2004 to roughly 9 billion rands today. We manage a spectrum of products, one being the Absolute Return Fund, which has been our flagship. And out of that, we've spawned the long-only funds. And lately, we've something that speaks to our philosophy of creating shared value in South Africa. We've spawned the impact funds, and later I'll be talking more about the renewable energy fund.
That, of course, is a particular passion of yours and interest. But let's talk about the BE space right now, because just looking at the numbers, in terms of total assets under management in the industry of around 3.37 trillion, BE asset managers only account for 5.47% of this. But we've seen considerable growth since 2009, around 79% in fact growth in the number of black fund managers. Tell us about this growth, but why it's still relatively small when you look at the total industry size.
Look, the growth is relatively small, and I think asset managers as a whole, regardless of being black, face a number of issues. And one is obviously brand or brand perceptions, especially when competing with more established companies. The second is the ability to attract talent and retain talent, more importantly. And that's always a function of your balance sheet. But I think, as you say, the numbers speak they speak a certain story, and that story is the slow pace of transformation in our industry. I think one of the biggest challenges we bring as a society at times, especially from a professional and social engagement, is that we bring certain preconceived notions and perceptions, and sometimes the merit of the argument is put aside. So I think the biggest challenge for black asset managers is overcoming some of those perceptions around competence, especially in the financial industry.
You know, it could potentially also, I mean, I think many of the issues that Masimo has kind of raised tonight is certainly very, very important. But I think maybe concentration and skill is something else that you potentially need to take into consideration. We have a graph that we'd like to show you that just shows you that concentration. And again, this comes from the 2074 BE survey. And if you just have a look at that, you'll see that most of the concentration actually happens in what we call the long-only space. That would be kind of your normal asset classes that you would be kind of used to. 2009, you can see how many participants were in this space, whereas today you can see there's over 17 participants in this space. But look at the hedge funds and private equity and all the way through to hedge fund, kind of the hedge fund industry. You'll see that, you know, that those numbers then change completely. Massimo, maybe a question for you. Do you think there's a concentration in skill as far as BE asset managers are concerned? Is it not maybe time that more of them start diversifying into hedge funds and maybe other areas rather than just concentrating on long only?
No, I certainly think so. I think there is a concentration in the long only space, and there are a number of reasons for this. One is obviously the space itself has a large pool of assets. The institutional mandates in this space are pretty huge. But again, I think globally, not only in South Africa, there's an aura around the long-only space. I think if an asset manager can beat his peers and beat his benchmark repeatedly, one derives some kind of intellectual distinction around your brand, and that too attracts a lot of flows and scalability. But lastly, I think over time, the long-only space has shown itself to beat inflation quite comfortably, and I think that's why it attracts young entrants into the market.
Masimo, from my side, just a question in terms of any new industry where there's lots of growth. Initially is seen in numbers, as in more and more of sort of competing firms. Then one enters a phase where you have more of a consolidation happening, and you end up with 3 or 4 big sort of dominating firms. How far are we away from consolidation and sort of clustering of assets into much bigger firms?
I think that's obviously a natural evolution, and you've seen some this year. I think in the next 5 to 10 years, you might see more consolidation. But that consolidation will take place in very homogeneous type of products. I think as boutique asset managers, we'd like to think we distinct in our offering, and therefore trying to merge 2 different philosophies becomes very difficult, especially from a cultural point of view, but also from a investment philosophy point of view. So I think there'll always be room for boutique managers.
I mean, I think the other thing to take into consideration here as well is this kind of the investor base that kind of lends itself to black economic asset management firms. It's predominantly been institutional. Again, just have a look at the graph on your screen, again from the survey, and you'll see that the majority of clients really come from the institutional space. These are pension funds, maybe provident funds, anybody kind of in the institutional space. It kind of makes up the majority of the client base, whereas retail really makes up a very, very small portion of the total client base. Masimo, again, going back in time, as the codes kind of changed for BE and it started fluxing into the industry, we started seeing a lot of pension funds saying, look, we need to invest with an emerging manager. And certainly we've seen the flows as far as that's concerned. What are you guys doing, or what is the industry maybe importantly doing in order to kind of more attract kind of that retail money? Is that something that you guys are working on?
Yeah, it certainly is, and I think it's part of your natural evolution as you go up your growth curve. I think there are 2 reasons why this has been institutionally driven. One is obviously parastatals and unions and retirement funds are highly politicized environments, and they've been pretty vociferous in articulating a transformational agenda. They haven't reached their targets, but certainly in their policies and in their objectives, there's a desire there to see a significant portion of their funds being managed by black asset managers. And I think that will continue, at least for the next 5 to 10 years. Secondly, as to retail, I think, as you know, personal savings in South Africa are skewed demographically. So for black asset managers to tap into a huge network of black investors on a retail level is often very difficult. But having said that, I think with performance over time and sustainability of brand, one will be able to finally break into the unit trust industry and the retail industry.
Masimo, we've seen the original sort of BE asset management firms have been generally focused on sort of passive kind of strategies, the Kagisos and the Vunanis. What's your view on the growth in terms of BE passive versus active management? Is there still a big growth going forward in terms of active management because there's so little out there at this stage?
Like I said, I think active management is an attraction. It yields better fees. From a business model and a business decision perspective, if you think you have the capability and the skills in-house to generate alpha from active management, I think that's going to continue. I think there will be room for passive management, especially in the markets such as we've seen. An age of deleveraging, an age of high indebtedness, and an age of volatility. I think there will be room for more passive kind of investments.
I mean, the other thing that I think we need to look at is just kind of how well do BE fund managers actually score as far as the DTI codes are concerned. Just look at the graph on your screen at the moment. You'll see the DTI. These are now the scores or the targets for black economic empowerment in South Africa, and it shows you the 25 asset managers that are deemed to be black asset managers, and it just shows you how they kind of score. They score fairly highly as far as ownership, management, control, and employment equity is concerned. So those are kind of the big scores. But down at the bottom, socioeconomic development, skills development, and enterprise development is something where they don't score that high. Masimo, is this something that kind of rings true to you in the industry? What do you think the industry should be doing about this?
I think to a certain extent it does. In our experiences as Mergence, there's been a direct correlation between our asset growth and our revenue growth and the amount of capital spend we allocate towards enterprise development and skills development. As I said, I think this is a business of people around the process, and inherent and intrinsic in that will have to invest in human capital or recruit the best talent out there. So I think that comes as you evolve your business.
Yeah, I mean, this is, it's so interesting because, I mean, if you think about it from a pension fund perspective, pension funds don't necessarily just give one manager all their money.
Yeah.
They usually choose a couple of managers in order to do so. So how a BE firm fits in from a return profile with just a kind of the kind of lock, stock and standard names that we know in the industry, and how they potentially complement those, and how you utilize those and use those become, classically kind of very, very important for pension funds. And only time will really unlock that. And Ken, kind of coming back to what Masimo said just now, it's time that unlocks that and unlocks the showing what the performance potential in many of these organizations can be.
And I suppose really another question is getting the skills into these boutique firms as opposed to going to the well-established, big brand names in the industry. And that, of course, will grow with time, but as these firms also grow. So Masimo, let's just go back to that. We talked about getting new skills. Just reiterate, what you're doing, I suppose, from Mergence's point of view to kind of attract this young talent into the company, and how hard is it as opposed to getting them, how hard is it to basically attract them versus the kind of packages they might receive from these bigger firms?
Yeah, that is one of the biggest challenges. I think established firms can easily poach good talent. We've been fortunate at Mergence that the core of the team has stayed the same, and I think that speaks more to our philosophy as a house and how we treat our people. We've been able to bring in 2 top names that we couldn't afford maybe a year ago, but as you go through a certain point in your assets under management, a certain revenue base, you are able to accommodate those skills. Like I say, this year for us, we've been able to balance the youth in our team with experience, and that experience costs.
Just looking at the survey and ESG, environmental, social and governance factors, it seems to be an increased awareness of the importance of incorporating these concepts and this kind of investment philosophy into your process. But it seems like governance is a lot more high on the agenda than for environmental per se.
Well, I mean, if you think about the environmental angle, it really is a new angle for asset management. The instruments that are available in that space is probably much less than what you have in the traditional asset class space. So hence, in the past, when you were an asset manager, you started in the traditional space and you kind of evolved yourself. Whereas, I think if you start off brand new today, it doesn't matter if you're going to be an empowered asset manager, you're not going to be an empowered asset manager, you're probably going to find it difficult to kind of attract assets because it's a two-edged sword. You walk into an investor and you say, can I please manage some of your money? And they say, well, you've got all your licensing, what's your track record? And you say, well, I don't have a track record. Then I say, well, then I can't give you any assets. And once you have a track record, then they say, well, what skill have you got? We can ascertain the skill from a performance perspective, but have you got a brand name fund manager that you could show me? And that costs money at the end of the day. So this is invariably just an industry that is just kind of cost money to run. And part of that cost is obviously running unit trust. And if you just look at the graph on your screen at the moment, you'll see just the number of unit trusts that have listed or are available to the industry participants. These are now predominantly BE fund managers. Started off with only 8 in 2009, and it's now gone over 12. I mean, 13, should I rather say. And I mean, that's a growing kind of evolution. Yeah. You want to see guys kind of enter that retail space, have their products out, out in the marketplace.
It's still small though, because the total number of unit trusts is 1,200, so it's still a very small proportion. But
and if you take
it is growing.
And if you take into consideration that there's 25 participants in this specific survey, there's very few unit trusts going around. Hopefully, we can see this exponentially growing over time.
Massimo, let's get back to impact investing rather, and I brought up ESG factors, incorporating that into your investment process. So tell us a little bit more about the role that plays at Mergence.
Yeah, we were the first signatories of the UNPRI, and we did collaborate in contributing to the CRESA codes before they were finalized. at Mergence, I think as a group too, I think there's a common thread that runs through the group, and that philosophy is around creating shared value, focusing on making profits whilst addressing social needs. And in that philosophy emanated our SRI, our SRI products. They speak to, we'd like to define ourselves within the national conversation, the public discourse. And that discourse speaks to the structural issues in our country, whether it be the income disparities in our country, whether it be the huge unemployment in our country, whether it be the educational crisis, whether it be the energy shortages. And through our impact funds, we've been able to innovate certain products that speak to or that try and address those structural issues.